Hello, and welcome to today's webinar, Seeing Beneath the Surface, Anticipating Hidden Risk in the Supply Chain. My name is Alice Bartram from Dun & Bradstreet, and I'm your moderator for this session. Today's webinar is brought to you jointly by Dun & Bradstreet and Zurich Insurance. Our two companies have a long-standing valued business relationship. Over the years, Zurich has been leveraging D&B data, analytics, and integration services to mitigate their own risks. More recently, we have been working together to demonstrate to our mutual clients the improved coverage and premium cost savings that can be recognized when deeper levels of diligence in supplier chain risk management is conducted. Our two speakers today have been involved in that collaborative work, so it should be a great discussion. Our speakers are John Ball, Senior Director, Analytic Consulting here at D&B, and Nick Wildgoose, Global Supply Chain Product Leader at Zurich Insurance. Before I hand over to the presenters, two things for you as the audience. First, please submit any questions through the Q&A box on your console screen. Secondly, we do have a quick poll for you all today to sort of gauge the audience. We are wondering, in your organization, are the supply chain risk management procedures linked to your insurance processes? We'll give that a minute or two to run. And while we wait for you to vote for the poll results, we'll have a quick look at our agenda. We're going to start off with Mr. Wildgoose from Zurich, covering both the causes and frequency of supply chain disruption, and also the development of risk transfer solutions. We'll then turn over to John Ball, who will share thoughts around analysis of your suppliers, or Tier N, as we call it. So again, we'll leave it a few more seconds for the poll to finish up, give everyone an opportunity to vote. Yes and no are running neck and neck at the moment. Oh, and a few not sures have come in. So again, we'll just give it another couple of seconds. And I'm going to go ahead and close the poll. And it's really quite fascinating. We have a split of 46% for both yes and no, and 7% of you not sure. So a pretty evenly divided audience here. Nick, as I turn it over to you.
Yes, thanks very much, Alice, and thank you very much to the audience for their feedback, and hi from me. So just to kick off in terms of what I'm going to talk about, and before I do that, just in context, supply or value chains, as I call them. And the reason I say that is that many of you out there who've joined this webinar realize that the supply chain is at the heart of your business. To give a couple of interesting statistics around that, 50 to 80% of a company's costs are in their supply chain. And the most common key performance indicator across businesses in all industry sectors is delivering for your customer on time. And if you have a disruption, you can't do that. So that's the kind of context. But let's now look at the problem that we're dealing with in terms of disruption events within the supply chain. Zurich have worked for the last 8 years with the Business Continuity Institute and the Chartered Institute of Procurement and Supply, two of the largest global bodies, in carrying out extensive research into what is causing disruptions in supply chains. We get, and thank you, some of you on this call may be responding to this, over 400 and somewhere over 400 responses each year. And what this slide shows here is a summary of that. And you'll notice in the bottom left-hand corner, it seems like a very small number in typeface, but is large in consequence. 70% of organizations are reporting they've suffered a significant disruption in 2016. Let me repeat that, 70%. Let's face it, we'd all say if it was only 20%, that was significant. And then just to put into context the significance of those disruptions, as you can see, 2% of them admit that these disruptions have caused them over 50 million euros of impact, or near enough dollars as well, from these disruptions. And by the way, I'm not surprised about that. When we in Zurich work with our customers in the area of supply chain risk and understanding their exposures, we frequently find exposures to a single supplier that are certainly in the tens of millions and sometimes in the hundreds of millions. And just to quote another piece of research, 80% of the losses that came out of the 2011 disasters, according to my good friends at Swiss Re, were supply chain related. As we know, the impact was in the billions for many sectors, particularly in technology and automotive, but it also cut across many other industry sectors. So we have a significant issue to deal with here. Just to give you a few more insights into the study, because you're probably asking yourself, Nick, that's very interesting, but what is causing these disruptions? And this slide, I hope, brings to your attention that, what are the causes? So you can see the top three causes are unplanned IT, loss of talent and skills, and cyber. I suspect you find that as somewhat surprising. By the way, the percentages are weightings, so there could be more than one response from a particular customer. This is interesting in the sense that historically, and I'll come on to this later in my talk, the insurance industry has focused on physical damage issues causing supply chain failures. But equally, as you can see here, there's non-damage events that can cause a significant issue. And the other thing that I don't think will surprise any of you, given how important information flows are within the supply chain, is that cyber risk, I'm afraid, is climbing up the charts. It was down at around number 20, I think, when we first started this work 8 years ago. It's now up to number 3. And I think this all illustrates as well the interconnected risk that goes on in the supply chain. The next insight, I think some of you may or may not be surprised about, and this is around where are those disruptions in the supply chain occurring. I find in talking to companies, most of their supply chain risk management efforts, at least historically, have been around their tier 1 direct suppliers. And they've said those direct suppliers are in turn accountable for the next tiers in the supply chain. But you can see here that even if you were perfectly controlled at tier 1, you would have a significant number of disruptions, in that around about half of the disruptions happening are below tier 1. And what we would advocate is that for critical supply chains, you need to put into place more actions, and we'll come on to that more with John, with your further tier N suppliers, if we call them that. And another key aspect and learning point I hope you can take away from this webinar this afternoon is there's a large number of companies who are not analyzing where their disruptions are occurring. And I feel, for a start, I think a lot of those are probably below tier 1, and they just don't quite know where they are. But equally, I think there's a very important point to be made here. Please capture the learnings out of your disruption events. It's all very well being the hero and solving the disruption, but how do you learn from that event and prevent it happening again across the organization? And I can cite a number of examples as well of where, just to illustrate that multi-tier exposure and how important it can be to understanding it. And that is where, for example, in 2011, the automotive manufacturing facilities in the US were being stopped because of failures of suppliers either out of Thailand or Japan, just to show again the interconnectedness of risk and the importance of understanding those connections. So there's a lot more in the report, and the report is available to all of you attending today. There's There's a section on attachments, so you can get the full report. I recommend it's a good read. And also, for those of you who are starting on a journey of trying to convince your execs around investing in supply chain risk management, there's a lot of useful pieces of information you can use there. So I'll now move on beyond the survey, but just to touch again, and largely I've done this already, but around the importance of transparency in your supply chain and driving that. And the fact, as we can see here, other studies have shown, unfortunately, there's a lot of poor visibility. And driving that transparency, as we know, certainly among the supply chain profession, is important not just from the disruption aspect that John and I are largely focusing on this afternoon, but also transparency in terms of the new legislative requirements around slavery, for example, out of the UK and California, CO2 emissions and other corporate social responsibility aims. And unfortunately, I think the latest tragic global weather events that have impacted many people across the world and many companies will again highlight the issues and the importance of having some understanding of your multi-tier exposures, which is what we're talking about today. And just finally, why have these multi-tier exposures occurred in these new business models? And there's really three movements that are going on, and I appreciate some politicians currently are looking to kind of change this a little, but when you think that global merchandise sales have doubled since 2005 to now, there's a massive movement to globalization that has gone on. There's also the leaning of supply chains that a number of you will be taking part in, and increased specialization. So I would argue, as your organizations are reducing costs, if they're not careful, they can be increasing risk and hence the danger of disruption. I would also urge you, from my experience of working with many companies out there in the journey of improving supply chain resilience, that in order to start this journey of improvement, you need to get top-down executive support. That is key. If you cannot get that, then it's tough to move forward. And that will also allow you, that top executive support, to align the different functional silos within your organization to ensure that you're all working to the same aim, as it were, which is to drive resilience in your supply chain. Hopefully that's given you a good background and understanding of how important value chains are and the importance of multi-tier exposures that we're going to come on to. So the other thing we said we'd do for this afternoon is to talk a little bit around risk transfer solutions. And I think in looking at risk transfer solutions, you need to put it into the context of thinking of risk and an insurance premium as a cost of risk. And I think one of the challenges we face in supply chains currently, and something we need to address, is to ensure in any decisions around supply chains that risk is properly embedded within it, the risk cost. And if you like, I would say an insurance premium can be a risk cost, particularly when we get on to talking around some of the innovations that Zurich has brought into the marketplace. As a result, I have to say, of our customers asking us to and helping us do it. So just looking at this slide, just to give you a little bit of history on the insurance industry for those of you who don't know. And clearly we have to work with our customers and move in the same direction. So the insurance industry largely was initially just covering the property, or, so your manufacturing assets and so on, and the business interruption around your assets. But as your models moved on to be more moving into supply chain areas back in the 60s, so 70s, the start of this, then we started to provide physical damage cover to the direct suppliers. And that model is evolving in the sense that now we are looking potentially as an industry at the further tiers of supply and both at a physical and non-damage, the physical and non-damage aspect of that. And we, along with other insurers, so other insurers are also introducing non-damage named perils, but as far as I know, currently on the marketplace, the only one to come from an all-risk direction is Zurich. And I believe, at least our customers tell us, from their point of view, it's the most advantageous, generally. So I'm just now going to talk you around some of these new types of insurance covers. Clearly, if you want to talk more about these, either offline or you can talk to your brokers about these new solutions that come along. And it's very important, it's interesting going back to the survey results, which were pretty evenly split. For those of you who haven't linked up your risk management with your insurance processes, I would urge you to do so. There's definitely a financial benefit in it for you and for your organization. And as I say, it's part of overcoming those functional silos that exist within organizations. So just to talk a little bit about the customer innovation that we within Zurich have brought in, and this dates back a number of years, but we've gradually been rolling out the solution in the last couple of years. So it's an all-risk cover, but it's only around named suppliers and supplies. So our focus is on your critical suppliers, which is something I think you will recognize. Certainly the procurement professionals out there understand about CRALIC, as it's called. So those key suppliers, critical suppliers to your organizations, the ones that help you make the profit, as it were. But we look at them on an all-risk basis, and the coverage is on an all-risk basis. And we cover the financial exposures, and by that I mean the lost profits and the increased cost of working. And you can see out of this process that becomes, on the left-hand side, not only financial benefits, but as I alluded to earlier, improved decision-making. Just to expand a little bit more on what we mean by all risks, this diagram hopefully gives you some illustration of that. So it can be around physical damage covers like NatCat. It can be around, just to pick out some of these, around power failure, or even insolvency if the suppliers of the appropriate grading, because obviously we have to check that. It can be around political risk. So, and you can recognize many of these cause disruptions in your, or can cause disruptions in your supply chain, particularly in a globalized environment. And when we're looking at a reduction in the output of your organization as a result of the failure of that named supplier and supply, we recognize that your supply chain is a competitive advantage, and you need to an insurer that understands and tailors a solution, just as Dun & Bradstreet does, to your particular circumstances. The other important point to pick out here is, provided we can understand the risk working with you in the multi-tier, sub-tier area, which is where D&B come in as well, then we are willing to give coverage for that. We recognize around these critical suppliers, as was shown in the BCI study, that failures can occur not just with the tier 1 suppliers, but with other tiers. And by the way, just because a peril is not included on this chart doesn't mean that you aren't covered under an all-risk policy. It's only when we've excluded it that it becomes, that you wouldn't be covered, which is obviously an easier route for you as a customer to understand. And we've been working, by the way, in this area for 7 years now, so we have experience of working in many different industrial sectors. Moving on to just give you a little bit more information about the kind of coverage that we provide, and as I say, there are other insurers moving into this marketplace, you'll be pleased to hear, more on a named perils basis. So as I say, what they require you to do is list down the things you're most concerned about, if you like, in the policy, and then they will consider the coverage. So I've already described the kind of coverages you can buy under the Zurich supply chain insurance. The indemnity periods and coverage we obviously tailor depending upon the particular industry or circumstance we're dealing with. And we do provide you with the premium, or as I described earlier, the risk cost on a supply and supplier basis. So, for example, we've had customers approaching us thinking they may want to insure, let's say, 5 critical suppliers. They get a separate price for each one of those, and they may choose in the first year only to cover 3 of those. We have a number of exclusions. I'm not going to go through all of those today, but just to give you an idea, things like quality we feel is something you should be able to control, whereas disruptions in your supply chain are quite often fortuitous and beyond your control. You know, ports closing down, new major regulations, maybe in China restricting output, whatever it might be. So hopefully that started to help you understand the coverage, and we have seen value out of this approach across, as I said earlier, all industry sectors. So I'm talking about high-tech equipment, construction projects we've helped clients cover. For example, a major wind turbine project in the US, just to give you an idea, mining, pharma is a huge area, and many of you will be aware how difficult it is if you lose a critical contract manufacturer in pharma to replace them in terms of the lead times. Before we ever give you any insurance, I thought it was important, and I think it links in well to what John's saying, is we carry out a value or a supply chain risk assessment, because we don't sit on actuarial tables like we might in terms of a motor insurance. It means we can fairly automatically work out what the premium appropriate to you as an individual might be. Clearly, as I said already, for these critical suppliers and supplies, that they're a different company by company, and we need to understand, as it says here, at the highest level, you know, where is the value? So what is the implication of this named supplier and supply failing? What risk do they face in terms of their particular production facilities? You know, how bad could it be as those financial exposures I talked about? And just to give you a hint, that is a very good number, if you like, to have in your business case or drive activity. I have known a number of companies that have unlocked their exec in terms of making investments in helping drive supply chain resilience through their making them aware, for example, it's $100 million exposure if this supplier fails. That kind of focuses the mind to say, goodness, we better take some actions. And the other valuable thing that comes out of our risk assessment is some other control measures. So we do work alongside Dun & Bradstreet, even just at a kind of consultancy level, if you like, to drive resilience, even if the client doesn't at that stage want to take a transfer solution. And part of this, very importantly, is mapping out where those supply chains are. Frankly, I'm still astonished when I talk to some companies out there and they don't even know where their critical suppliers are, which leads me neatly into the next slide. And you might say, Nicholas, goodness, that's a lot to take in on an afternoon or morning like this. I've deliberately put all those boxes up there. And the key, just the one key message I want to get across to you here is, as well as looking at critical suppliers in a multi-tier aspect, which John will come on to, it's important you think about risk in a comprehensive way. As I just said, I'm still amazed how many large corporates do not even know whether their critical suppliers are exposed to flood or quake or whatever, although they might have spent money doing financial appraisal, which is great, but it's getting that balance. And what about geopolitical risk? Even at your tier 1 level, let alone, as John will come on to, at other tiers within the supply chain. Picking another box out of here, have you got exposures in terms of legal cases, skills and IP management against your suppliers? There is big data out there that can help you understand that at a relatively low cost nowadays. So in our risk assessment, we're looking at this, and we're looking at this in the context of what are the other alternative suppliers, if any, for you in the industry marketplace. Good procurement teams in major corporates have already done a lot of this strategic sourcing, but this gives you a kind of structure which I think is very useful to that comprehensive approach. And I'll just end with one more example before I hand across to John, and that's in just picking out the box on supplier relationships. Clearly, these are critical suppliers to you, so you've identified that they're important, but always try to understand whether they regard you as a critical or preferred customer, I think is the general way of describing it. In other words, if, for example, you're taking 10% of their output, but 90% is going to a major automotive company, if they had a capacity issue, would it be the major automotive company or yourself who get the remaining capacity? I leave you with that thought. I will just now hand over to John to talk to you about the great work that D&B have been doing in the area of Tier N analysis. Over to you, John.
Thank you, Nick. For those of you not familiar with Dun & Bradstreet, we collect and organize business-to-business risk and marketing data on close to 260 or so million companies globally. And this gives us quite a treasure chest or unparalleled advantage in creating predictive scoring solutions for trade credit, lending, sales and marketing, and of course what we're going to talk about here, supply chain. So when we talk about supply chain or Tier N, what we're referring to is really that hidden supply chain, the Tier 2s, the Tier 3s, what's happening beneath the surface, and do my Tier 1s have potentially a hotspot of risk, or is there convergence or bottlenecks down into the sub-tier that otherwise might be quite invisible? And what we have is part of this massive collection of information on companies. We also have quite an incredible supplier network where we see definitive buyer and seller relationships on 100 million companies globally. And this is quite an enormous advantage in how we can take a digitized approach in technology and automation, tap into our proprietary network, and essentially auto-map Tier 2s and Tier 3s, and simultaneously append various risk factors tied to those Tier 2s and Tier 3s, and point out convergence or bottlenecks where that same key type of Tier 2 might be used by multiple or many Tier 1s. All of this gets outputted as well in various ways. You can drill down on hotspots of risk, but also in what we call an SCRI score, which is an index score that assesses the aggregate risk of a Tier 1's extended or sub-tier supply chain, which has a variety of influential factors that go into that score. What's quite fascinating, and we've seen this time and time again, if the Tier 1 from a D&B lens is showing high business health risk, which can be predominantly driven on slow or poor payment performance, which gives us quite an advantage in how do we assess a very large number of smaller private companies where financial statements might be very hard to obtain. If we see a high business health risk for the Tier 1 and simultaneously we see a condition that they're using a key type of Tier 2 that also is showing high business health risk, when both conditions exist at the same time, we see an incredible probability or propensity that that Tier 1 will have a performance quality escape issue 6 months down the road. So, not too surprisingly, if a company is struggling themselves, typically that cut corners that impacts quality of product, but also if they're using key types of suppliers at the Tier 2 level that are also struggling, having both conditions really isolates a very small pool of suppliers in a portfolio and shows incredible odds that an issue might be happening 6 months down the road at a very high probability. And what's quite fascinating is if you could just get in front of just one of those, and preventive value chain disruption can have quite an impact on a company. And then this here just shows, as I talked about, these various types of risk factors, and looking at this summary view, Here you can see at the Tier 1 level, that's your direct supplier themselves, and here we can see that this supplier is experiencing M&A activity. So we specifically delineate and call that out. But you also see various risk factors such as bankruptcy, major financial distress. You see OFAC, you see EPLS, which is debarment. Are they located in high-risk countries, et cetera? And you can very quickly drill down and see what exposures might be down at the Tier 2 or Tier 3 level, but more importantly, filter by relevant types of industries or relevant commodity code descriptions to see if there's potential exposure there in the sub-tier stemming from that Tier 1. And this gives an example as well of just how incredible our supplier network is and how fast we can essentially discover all these Tier 2s and Tier 3s. And this is just showing an example of this company, Ajaxi Stamping. Here you can see that we quickly discovered a plethora of Tier 2s all over the world, as well as a pretty good footprint of Tier 3s that you can see here. And this will allow you the ability to see, gosh, do I have supply chain connections in very high-risk countries, for example, or countries of concern, or just very, very recently we've had a slew of natural disasters. You could drill down on places like Puerto Rico and filter by key types of suppliers to see, are you impacted at the Tier 2 level and what Tier 1s have that exposure. Same thing with central Mexico, where we had a huge earthquake in Mexico City, and of course Hurricane Harvey and Irma. These are all really quick ways to answer those questions of, okay, I know where my Tier 1s are, but key question, do I have key types of Tier 2s that are in those natural disaster areas and or just a country of interest or area of interest?
Excellent. Thanks, John. And thanks also, Nick. Hopefully, for the audience, we're going to wrap the presentation portion up and move to Q&A in a minute. And hopefully you all agree with the takeaways from the session here. Your company's performance really is being impacted by supply chain disruption costs, whether you know it or not. Therefore, we feel, obviously, you must be proactive and prioritized in your approach to critical suppliers on a multi-tier or tier-end basis, and John showed you some of the ways to help with that. Technology and risk transfer innovations are starting to be adopted by your competitors, again, whether you know it or not, and our feeling is you need to be sure that you're keeping pace. And again, hopefully between the two presentations from D&B and Zurich, we gave you some ideas there. So let's move on to the Q&A portion with Nick and John. Just a reminder, if you have any questions, please type them into the Q&A box on your console. And another quick reminder that the full report on supply chain resilience is also available for download from your console, so hopefully that's useful to you. We have had a few questions come in. I'm going to combine a couple of these here, and I think they're best placed for you, John. Questions are, how do I get started looking deeper into my supply chain? And once you start the multi-tier or tier-end process, how soon before you see results?
Yeah, so what's quite fascinating and quite an advantage, that we have is we just simply need a list of your Tier 1 or your direct supplier's name and address, which is that's really all we need. From there, we actually match to the D&B DUNS number, which is location specific and is the glue that ties all these connections together in that network. And literally in about a 3-week process or period, we can actually map and discover a huge number of Tier 2s and Tier 3s globally just by you providing us a list of Tier 1s.
Excellent. Next question, I think, Nick, I'll direct to you. What are some of the steps you can take if your multi-tier analysis indicates a high risk in a particular supply chain?
Right, thanks, Alice. So one of the things is just simply looking at, do you have alternatives at the tier 1 level, making sure, by the way, that they don't share a tier 2 or tier 3 key supplier as best you can. Otherwise, you kind of move from frying pan to fire. There's also the option to build up inventory, to look at business continuity plans, for example, with your tier 1 supplier, insofar as how are they going to help you out if there is an issue at the lower tiers. As we discussed earlier, risk transfer can be part of that solution in terms of balance sheet and cash flow protection, which particularly for some companies where they need that financial protection, that can be valuable. So hopefully, Alice, that's just some of the ideas, and just frankly by being aware of where your tier 2s and 3s are of your critical suppliers, being second in this race to get capacity is no good. Being first is the place you want to be to react quickly to an incident. Hopefully that's useful.
Excellent, thanks. And a follow-on came in here. What are some of the things you should think about in general terms in looking at insurance cover?
I guess you're referring here, Alice, to insurance cover for supply chain. Firstly, I would say doing an analysis, as I've said, of an understanding who are your critical suppliers. So by that I mean, in simple terms, looking at your most profitable product or service and saying, on which suppliers do we depend upon at the tier 1 level to start with to deliver this service or this product. So you may look at the bill of materials, for example, in a manufacturing process. And then, having identified those critical suppliers, then start to look at the tier N analysis as appropriate, where you've got particular concerns about that supplier, and so on, and breaking that down and looking at the comprehensive risk assessment around those key suppliers. So, and as I said in my presentation, please make sure you've got the executive buy-in, you've made the business case, and you're joined up across the functions, because there are great practices hidden in your organization, probably in the different functions. Bring them together in that analysis work. I hope that's helpful, Alice.
Yes, excellent, thanks. And there was a comment from the person who asked the question, so it sounded like that was on the spot. And that concept of executive buy-in and sort of organizational alignment is so key in so many areas, so I'm glad you re-stressed that. Good. So we've covered the questions that have come in. If anyone has a last-minute one, please type them in. And if not, we will thank everyone for joining us today. We hope that Nick and John were able to both educate and excite you as to the possibilities of deeper supply vigilance. In the next day or two, you will receive an email from us with links to the webinar recording and the deck so that you can have that for reference and share it as you need within your organization. And again, thank you everyone for joining us today. Oh, wait, there's a question that just came in. How payment digitization, e-invoicing, blockchain could play a role in reducing the delays caused by old processes. I don't know if John or Nick, you have thoughts on that.
We probably both have some initial thoughts. Shall I kick off initially, Alice, and then hand across to John?
Sure, why don't you? That would be
great. John's answer will probably be better because he'll have more chance to think about it. But I think, as we've hopefully shown in this presentation, one of the answers around improving supply chain risk management, as the tier N analysis has shown, is technology, which is referred to here. So in order, I'm often asked by procurement directors from large corporates, Nick, my challenge is, how do I scale up to deal with even my critical suppliers? There might be 100 of them. I don't have enough staff to monitor them as closely as I would like in a manual basis, so you need the technology. And then secondly, the technology comes into play, and I think blockchain will have more of a role in this in the future, but in terms of, firstly, multiple risks, as John showed in the ability to bring forward and bring together different risk factors, so geopolitical, nat cat, financial, and so on, to give you a holistic view of the risks that really you face in your supply chain. John, I don't know if you have anything further to add into that?
Yeah, well, I mean, just any time you can kind of digitize or kind of automate, and quite an advantage we have with our network is just doing that, right? So if you've got a portfolio of a few hundred or a few thousand suppliers, traditional ways, I think it's really great where you get very specific and detailed information, but you certainly can have scalability constraints, and it can be very arduous. Being able to do things, leveraging technology and digitized connections, can be quite an advantage, and very, very quickly mapping, but more importantly, seeing the risk factors appended to these sub-tiers, but also isolating, are there key tier 2s that are showing high risk, and tier 1s. You can quickly isolate a very, very small pool in your portfolio that really has the most risk stemming from it.
Excellent, thanks. So no other questions have come in while we covered that one, and thank you both for those thoughts. So again, we'll thank everyone for joining us. Please keep an eye out for that follow-up email, and feel free to reach out directly. Thanks again. Have a great day.